And with that, ladies and gentlemen, the sound of the trumpets, most of you know that means it's time to begin. Please put your hands together and welcome our host and presenter from FarnsfieldResearch.com. Please welcome Fargo.
Thank you for joining us. My name is Brandon Fargo, and I'm head of the individual accounts here with Farnsfield Research. Again, I want to thank everybody on here for joining us today. I'm really excited to see we've got a large attendance here on people that are interested in the new turtle option strategy, which has been helping a lot of my clients already in their own accounts and with their own trading. You know, a lot of people are on here for different reasons, whether you are already trading on your own, possibly looking to add to your own strategy, or looking to learn a whole new strategy or follow along with a highly experienced trader like Russell Sands and the Turtle strategy. This strategy will absolutely be perfect for you because it's been tried and true for over 30 years and been successful for that long. A lot of people over the last 10 years have said that trend following might be dead, and I can assure you that it's not, and you're about to learn why in the next 45 minutes here. So a little bit about me. Click over here. There we go. There I am. That's my beautiful girlfriend. I grew up here in San Diego. I went to school here as well. And after school, I started working with my family in the restaurant business, along with real estate and development. That was our main business. We did homes on spec, commercial buildings, and did quite well for a lot of years. Unfortunately, 2007 hit us hard when the real estate bubble collapsed, and I learned the hard way about diversification and having all my eggs tied up in one investment vehicle, being real estate at the time. I moved out of real estate and had always had an interest in the markets and trading and got connected with Farnsfield Research and actually started working with them here and the traders that we represent. What I will tell you is my eyes, along with many doors, were open to endless possibilities, and now it's my mission and what I get to do is share that experience and opportunities with other people around the world, just like you guys sitting in this room right now. So obviously, again, everybody's here for a reason. I can tell you that our company has searched and searched for traders over the years out there, and it's actually an extremely long, drawn-out process to find something real and working and that actually makes money in the markets. But the benefit of working with a company like ours is we've done all the due diligence and are aligning people like yourself with traders that are real and strategies that are actually making money and something that you will be able to utilize for years on in your own accounts, which is what really people just want, something that's real, working, and going to make money. Let's go ahead and get into it. Today we're covering the turtle options investment strategy. Again, it's been traded for over 30 years. And if you walk down the path with us and Russell Sands, that can become true for you guys as well. I'm sure you've all heard of the turtle traders. It's a pretty famous story. If you haven't, I'll give you guys the Cliff Note version of the story so we can get into the actual strategy and how it's implemented. But basically, back in the 80s, there was a famous futures hedge fund manager. His name was Richard Dennis. Richard was really famous because he had taken a $400 family loan and he turned it into a couple $100 million within about 4 years through trading. Richard believed that you could take literally anybody off of the street and teach them how to trade successfully. And his partner, which his name was Bill Eckhart, he disagreed with Richard. He thought that Richard was an anomaly, nobody could match what he had done, and that you had to have knowledge about the markets, and again, nobody could match that. So what they did is they actually made $1 million bet, and they put an ad in the Wall Street Journal and hired 15 people out of thousands that had inquired for the opportunity, none of which had any experience in the market at all. The only experience somebody had was one guy had built some of the first computer platforms that were used on the CME. But other than that, nobody knew anything about the markets. They called this group of 15 people the turtle traders because they were having that argument in front of a turtle pond in Singapore. And so what they actually did is they brought these guys in. 14 of them showed up on the first day, and they stuck them across the street of the Chicago Board of Trade in a conference room in a hotel, and they gave them 2 weeks of training. And then after the 2 weeks, they handed each one of them $1 million cash to trade with. All of them were successful. There was not one person that lost money. Obviously, there were probably ups and downs, but nobody lost money. And actually, it was so successful that they decided to do another round and hire 10 more people the very next year. Now, Russell Sands, which is the trader that we work with, and we've been working with Russell for years, he was one of the most successful out of the 14. He has a real impressive background, a real rag to riches story, you could say. I mean, he put himself through NYU as a cab driver in the Bronx. And after getting his degree, he actually was a backgammon and blackjack player professionally. He was so good and actually wrote a book on how to count cards, and he's actually not allowed to step foot in a casino in Atlantic City. So he's a numbers guy. But he left the group after about 1.5 years, and he's been trading ever since. He eventually set up his own hedge fund, which does very well, and he trades $1 million in the market every year. Okay, now he's written a lot of books on the turtle rules, and even in the Forex, he developed the Forex strategy 15 years ago, and now the options, and also tours the world teaching people the method through seminars and different classes. And actually next year, we're going to be doing a full tour here in the U.S., Los Angeles, Chicago, New York, and possibly even down in Boca Raton, where he lives. And it'll be a 2 or 3 day event. It's going to be a lot of fun, so we'll make sure everybody gets an invite that attended today. Now, originally, the Turtles method was geared towards the futures and commodities markets. What you need to know about Russell is he's a very forward thinker. About 15 years ago, Russell developed the same strategy in the foreign currency market, which is very successful. And then 5 years ago, decided to go into options on ETFs. Again, just knew that there was a lot of money to be made in those markets. Basically, what he did is he took the original turtle method and made a few changes in the money management to accommodate for the ETF markets. And it's obviously much different from futures. I mean, the volatility is much different. And by the way, if there are any questions, guys, let's hold them to the end. I'm going to get to everybody, and I'll be able to answer everybody's questions at that time, okay? 4 key points of the strategy, all right? It has a defined entry strategy. We also have money management, risk management, portfolio diversification, and the 5th and final one is a defined exit strategy. We'll start with the defined entry strategy. It's a very simple option strategy. All he's doing is buying directional calls and puts based on a breakout that's going to be created within a 21-day period. All right, now what he looks for is basically a channel breakout, so a higher high or a lower low that's created within that 21 days. Now, if a new high is created, we're obviously going to be buying calls because we're looking for the market to continue up. If a new low is created within that 21-day period, we're going to be buying puts. So you'll be able to take advantage of both sides of the market. And on top of that, you can even use this strategy with an IRA because it's not complex. We're not doing anything exotic. Again, very, very simple. The strategy itself is going to be 99% linear and mechanical, meaning we enter on price, and there is never a question of whether you should or should not enter a trade, which is the real problem with a lot of strategies out there, a lot of these so-called gurus. A lot of it is left up to people's own thinking, and that's actually how a lot of emotion gets involved. So the strategy and the reason why it was successful is because it takes 100% of the emotion out of the trading. For better, for worse, Russell will tell you, and he'll also be the first to tell you he has no idea what the market's going to do, and he doesn't follow fundamentals. This is 100% technical, and it's built to capitalize on some of the bigger moves in the markets and follow trends for as long as they're going to go. The only discretion, the 1%, since we are dealing with options, is going to be the open interest on the option and the volume. Obviously, at times, depending on what's going on in the market, like if we look at right now, the volatility is real low, the volume's real low going into this election. Well, I don't even think we should call it an election. It's more of a circus show, but that's another conversation for another day. But getting back to it, I mean, the point I'm trying to make is that's the 1% of discretion, which Russell will assist you in, and he does have guidelines on that. He's buying puts and calls at the money or slightly out of the money. And we're looking at about 4 to 6 weeks out of expiration. So these are not long-term trades. The average hold time on a trade is actually going to be about 1 to 2 weeks, and sometimes longer if we get a big trend. He's looking for tight spreads, okay, so and a very defined entry. He uses limit orders. And again, he's looking for that higher volume and open interest in addition to cheap options so we can purchase multiple contracts and really be able to utilize our money as a tool, so to speak. Second point is the money management, which is extremely important. And when you read his book, you'll start to understand, really who Russell is. It's more about protection and capital preservation, and with that, capitalization comes. But he never risks more than 5% on any trade, and we're never going to be in more than 5 trades at a time. So you're never going to be over leveraged. He doesn't ever want to hold excessive risk in any market, no matter what is going on. This is not gambling, okay? And having set money management rules like this are what are going to produce for you in the long run and separate, you from the other 90% of the people out there. As far as the risk management is concerned, he utilizes the average true range to determine his risk or pain threshold on every trade. Basically, it's going to measure the range of the market over a certain period of time. And this way, if an asset's range is tighter today on average than it was 6 months ago, again, we don't have to hold as much risk in that market. We can know that we're wrong much quicker. Also, just because we have a stop placed does not mean that's our only exit strategy. If we are down 50% on the option and getting close to expiration, he is going to cut that trade short rather than, waiting and praying and hoping that the market will come back to even or even in a profit. He doesn't mind taking losses, and that's what you're going to see. He actually wins 1 out of every 2 trades, and we've got about a 3 to 1 risk to reward. And we know losses are going to happen, but it's really about having the winners outweigh your losses. The fourth point is going to be portfolio diversification. Russell looks at about 35 different ETFs. But again, we're never in more than 5 trades at a time. So we trade a variety of different sectors, anything from retail, technology, currencies, metals, tech, the list goes on. A lot of S&P products, a lot of great ETFs, highly liquid ETFs, but again, you're never in more than 5 trades at a time. Russell uses a trailing stop. This is the exit strategy. A trailing stop that will trail the price of the market depending on what the ATR is at that time. So on average, we're seeing about 10 to 20%. Now, if the market moves in our favor, 100% on the option, the stop will get real tight against that price to protect and preserve as much of the profit as possible. Now, I know this is very vague right now, just hitting on these key points. You guys can call in. You can talk to either myself or somebody here, and we can get more into detail about the exit strategy with you. But for the sake of time, just going over some of the main points here. Also, when you purchase the product, you get to work side by side with Russell and his team, and he'll actually teach you the method just like he was taught in Chicago back in the 80s. So let's actually get into some charts here. and I can kind of go over some entries that we've seen over the last couple of months. We can take a look. This is XLV, S&P Healthcare Fund. Now again, we're entering on a 21-day breakout. And depending on what calls or puts are available, we're trying to get as close to the money as possible when we enter. So you can see this is a 21-day breakout. If we look 21 days back, we've got this level here, a lot of liquidity there, and you can see we get a nice burst. And that's the thing, we're looking for the move to really be established in order to enter the market. So obviously here we've got a nice trend already developed. We had an inside bar here, so accumulation, then we get a pop up above that high, and it really breaks out from there. Now, where a lot of people go wrong, it's really easy to enter a trade, and a lot of people know how to enter on a breakout. But the money management is the real hard part. You know, without money management rules, you're left to your emotions going up this chart here, or up the scale here. And a lot of people, you know, might cover too early, think that the market's going to roll over, especially in here when we get some of these, you know, doji candle patterns or whatever you want to call them, spinning tops, and there's all sorts of different names for different patterns which Russell doesn't follow. A lot of them are fallacies and built to create emotions in people, and you're just providing liquidity at that point. So again, he does trail the price of the market at about a 10 to 20% retracement. That option is going to continue to move in our favor, and you can see here, I mean, we're up 100% on that option at that point. It breaks down, that stop is real tight, and we're out. Now let's say it continues on up. I mean, we've got a new entry order up here at 76. Okay, so if the market does get some volume here and some momentum behind this trend and it pushes up through there, you know, it's going to hit our limit order and get us back in if there's a trade available at that time. But you can see here, I mean, we made $119 per contract traded there on that one trade. You know, and that's the beauty about options is you do not have to hold a ton of risk. I mean, you could see that our fill price was $1.52, so $150 per contract there. So if you had $500 allocated to this, you would have been able to make a nice trade there over a short period of time, if that makes sense. Let's take a look at another trade here. This is XRT, another great one. You know, we got in at $1.29, 43 calls, so slightly out of the money at that point. There's our breakout. And again, we're looking for established moves. Now, there are more indicators that are involved here, not just a simple breakout to help us with directional bias. But again, that is part of the service. Russell will teach you all the ins and outs, how to calculate your position size, how to enter, and more importantly, how to exit the trade and the money management that's involved. But you can see here again, this market came up. Now, most people are going to dump the trade here. They're going to think this is going to pull back in probably into these highs. But it ended up continuing on, and we got a nice $77 gain per contract traded there. And again, that trade only lasted 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. Okay. Again, if we break the highs and it continues on, we're going to go ahead and take that trade and get the continuation. All right. Now let's take a look at another one. This one ended up almost break even. You can see here's our breakout. It was actually off of a gap up. We still got a good price. Everything's done by limit order with Russell, so there are no market orders involved. Those orders usually come out about 30 minutes to an hour before the open. And again, they're very defined. There's no questions, ifs, ands, or buts if you take the trade or not. We got into this trade, didn't last too long, about 5 days, or excuse me, 6 days. Got out, almost break even, but with a small profit. We didn't lose money on that one. That's the other thing. The losses with this are extremely small. And again, that's because with options, we don't have to hold a ton of risk to see a good return. This was a pretty simple entry. You can see here the market accumulated for quite a period of time here. So there's a lot of orders in here, and we got a nice breakout up after this stop run here. So off of that 21-day high, this one stalled out a little bit, but then ended up running. And we got in at $1.11 and got out at $1.38. So a nice profit there, okay? But very simple. And again, you know, once we're in the trade, the money management is very defined. You know, as that market moves in our favor, our stop is going to move every day up behind that. Here's some of the performance. Okay, this is over the last over 32 months. Okay, it's been very profitable. Trades are based on a $10,000 initial investment, utilizing $500 per trade. It doesn't take a lot of money to trade options, folks. You can start off with as little, you know, as $1,000. If you're going to be doing auto trade, most brokers are going to recommend a minimum of $5,000, and they're going to utilize about $250 per trade per $5,000 in the account. So pretty impressive stuff as far as what we're looking at here. You can see the total net profit, and again, this is non-compounded, so without reinvesting a single penny, you would have made about $69,921 in that 2-year, 8-month period of time on a $10,000 account utilizing that $500 per trade. Now, we rounded up every trade, so let's say the $500 would have gotten us 4.5 contracts. We would have bought the 5th, so it might have averaged out to about, you know, 550, 560, but that's the overall average of what we were looking to utilize. Let's look at the risk to reward here and the amount of trades that we've won. You can see we're winning 1 out of every 2 trades. We've got about a 53% win rate. Okay. Average trade net profit between the winning trade and losing trade is $369. Your average winning trade is $578, and your average losing trade is $209. So you're at about a 3-to-1 risk to reward ratio, okay, which is the most important thing. I've been trading for a long time, and I see a lot of these guys out there. They've got, you know, 80, 90, 99% win rates, but their risk to reward and their money management is absolute, you know, baloney. And it just doesn't make any sense. And that one losing trade can wipe out, you know, a year's worth of winnings, okay, or a month's worth of winnings. And that's where a lot of frustration's created, and you don't see a lot of success on that end of it. In my mind, and most professional traders' minds, the risk to reward is going to be the most important thing, and how is the money management built to really capitalize on different trends in the market. I mean, we know there's going to be losses, and as long as we have a defined exit strategy to cut those losses short, and then let our winners run, we're going to be successful, because trends are going to happen, breakouts are going to happen, and the way this strategy is built is to capture some of those bigger moves and some of those trends in the markets. And if you're looking to make money and generate income, this definitely will do it for you. I mean, we've averaged monthly on a 10K account about $2,100 in income. And that can be done completely passively for you, or again, you can do it on your own, either way, which equates to about 21% a month. Now, again, that's non-compounded. Russell recommends compounding every $5,000 in the account, meaning, again, $250 per trade, and that way if you were to hit a drawdown, you would have been able to withstand double our max drawdown without having to add any money to the account to continue to trade at the same level, if that makes sense. Now let's touch on the drawdown. That was about $2,600, or 26% of the account, okay? That only lasted 34 days. Now that doesn't mean that there aren't flat periods. That doesn't mean that there aren't losing months. You can see the profitable months is about 90%. But what it does mean is that, again, the losses are cut very short. Okay. We can go down, covered everything pretty much here. Here's the equity curve. Pretty smooth. Okay. Now, what I really want people to focus on is not these big run-ups, even though they're impressive, and ultimately that's what we're looking at. But look at the drawdown periods. I mean, yes, you do get some flat periods, but again, they're extremely small, okay? And usually after a flat period or after a drawdown, the market, or the strategy, I should say, really breaks out. And we get another flat period, really breaks out, and we're in a flat period here. Okay, volatility is lower in these periods of time. Markets are flat in these periods of time. But then once they start to move, we really start to see some breakouts. Now, if you guys are going to be subscribing at this time, it's the perfect time because within the next 3 weeks, the volatility is going to be picking up going into this election and after. I think a lot of people are sitting on the sidelines. Volume's a little bit low, but we're already starting to see those formations, especially in commodities, in stocks. We're seeing a lot of action, a lot of manipulation going on. To give you an example, I mean feeder cattle, a lot of commodities, like sugar, feeder cattle, OJ are starting to move. We're also seeing it in the S&P. The S&P had a great day today. You could have seen about 18, 20 points this morning. And then as far as in the traditional stock market and ETFs go, we're starting to see the volatility pick up. I mean, if we were talking a month ago, the VIX was down, which measures the overall volatility, was down about at 12. And now we're seeing it move up to about 15 or 16. So the point I'm trying to make is going into the last quarter of the year here and into the new year, we're anticipating some bigger moves and maybe even a correction. And this type of strategy, which is built to take advantage of those bigger moves, is going to be able to capitalize on that. So you're better suited to learn this now and start trading this now so that you're prepared when those moves do happen, because they are coming. Okay, so let's go over the service, what you're going to get. Full education. Okay, Russell's going to send you the full trading manual and the Turtles rules for the strategy, meaning all of his hard work over the last 30 years, he's going to hand you on day one on a silver platter. You're also going to get a full mentorship with the service. Anytime you have questions pertaining to the strategy or the service, you can call Russell Sand's office directly and speak with either him or his team, which his team collectively has probably been working with him for about 15 to 20 years. They'll answer any questions, break down everything for you, and go into the nuts and bolts. They love to do this part of it. They love to teach it. Okay, there's no extra charge for that. It comes with the service and does not cost a penny more or less, whether you take advantage of the education or not. Regardless, you'll get a write-off for the fee since this is educational. For those of you who don't want to learn the service and just want to follow along with what Russell Sands is doing with his own money, you can have it auto-traded at a third-party licensed and registered broker, which is what the majority of people do. But this way you can sit back and let the professionals go to work for you. The process is very simple. Russell will send the signals to your broker directly, and they can execute on your behalf. Meaning the second that Russell's in a trade, you're going to be in it with them, and the second that he's out of that trade, you're out of it with him, completely hands-free. So any profits that he's seeing on his account, you're going to see on yours as well. Everything is done by limit order, so exact entries, exact exits, which is also going to ensure good fills for all the clients. We've spent a lot of time and money over the years, along with the brokers, to put different platforms in place to make sure that people are able to replicate and mirror what Russell is doing at all times. Okay. You're also going to get daily trading signals. Okay. So those will get delivered to your inbox anywhere between 30 minutes to an hour before the open of every day. They are by limit orders only. Okay. You'll get the stop loss, strike price, expiration date, and entry price is all given to you. So if you are one of those who, does want to go ahead and trade this on your own, you'll get those signals. Every once in a while there is an intraday signal, so you'll just need to pay attention to your email. But on average, we're only seeing about 11 trades a month. Okay, this is not hyperactive. This is not something that is in and out of the market every day and going to rack up a big bill in commissions for you. Okay, Russell's philosophy is that he'd rather sit in cash and wait for the market to prove itself to him rather than just being in the market to be in the market, which I'm sure you can all agree with. If you're a newer trader, you've probably got that itch to get in the market. All I can tell you is it's better to sit and wait for everything to line up perfectly, kind of like a baseball on a T-ball stand. You know what I mean? You want that ball perfectly placed so you can knock it out of the park, which is exactly what Russell does. As far as the strategy goes, again, I've been working with Russell for since I've been here, 9 years. He's been working with our company for almost, I think, 12 or 15 years. The strategy is phenomenal. It's been proven over the last 30 years. And if you're looking to make money in these markets, this is definitely going to help you do that. Let's get into some questions here. I see a few have come through, so I'll just start at the top. And if you guys have questions, go ahead and type them in now so we can get to them. Can I trade? Bri asked at the beginning, can I trade this? Maybe it's Bree. Sorry. Can I trade this in an IRA? So yes, you can. Okay. The strategy is only directional buys or buying puts and calls. So it's very appropriate for IRAs. I have a lot of clients that utilize it within their IRA and are able to see that grow tax-free or tax-deferred, depending on obviously what kind of IRA you have. How are the signals coming over? Very simple. Okay, it gets sent out by email. Again, 30 minutes to an hour before the open of every day. Everything is done by limit order. So if there's a signal that day, you're going to get the entry price that we're looking at, what call or put we're looking at. You're also going to get the strike price and the expiration date. Then as we're in the trade, and that's going on over the next week, 2 weeks, every day there's going to be an update to where your stop is, which is also your profit target. Because again, Russell is one to let his performance really, or to let his winning trades really run. So you'll get those updates as they come out and as the market moves in our favor. Are the signals limit orders marketers? Just hit that. Do I have to sit in front of the computer all day? No, you don't. Again, you can either have this auto traded or you just simply set up your limit orders in the morning and then go about your day. How quickly can I compound? That's up to you, Tom or TT. It really depends on what you're looking to do. Russell recommends compounding in $5,000 units, using $250 per $5,000 in the account. And that way you're able to withstand losses at the same rate without having to add any money to the account. Okay. Venture asked, will I work with one of the Turtles traders directly? Yes. You get to work with Russell Sands. He's one of the original 14. You'll be able to call him at any time. He's a workhorse. Him and his assistant Steve, they're in their office all day. They live in a beautiful place down in Boca Raton. They are busier in the morning getting orders ready, but as the market's open, they've got everything set up. They're ready to go. You can call them at any time. Now, if you do take advantage of the education, Russell does prefer that you go through the manual first, write down questions that you have so you guys can have a more productive conversation. TK asked how the signal's coming over. We covered that, again, by limit order and email. And then Tim asked, is this actual performance? Yes, this is 100% actual performance. Every trade that I showed you was taken by Russell over the last 2 years, 8 months. If you had started back at the same time on the auto trade or receiving these signals without reinvesting profits, this is what you would have made, the $69,921. I may have missed you saying this. Buy low, sell high ask. May have missed you saying this. Are these signals limit orders or market orders? All done by limit. So we are looking for an exact entry and an exact exit. That signal is going to be good for the day. New signals will come out the next day. So if that limit is not hit at the end of the day, it gets canceled. Okay, and then the next morning it'll come out with a new signal, because obviously you're looking at a 21-day high. So if the 21-day high or the 21-day low, for that matter, if we're going short, if it's different those days, you just need to pay attention. Also, volume, volatility are factored in there. So there will be a set of signals every day as far as what's going on if a trade is going to be taken. All right. I hope I've covered everything. But again, if there are any other questions, you guys can call us here at Farnsfield. Again, my name is Brandon Fargo. You can either speak with myself or one of our guys here. The main line is 1-800-883-0524. Or you can call direct at 832-404-2420. You can also email us at support@farnsfieldresearch.com or visit our website at farnsfieldresearch.com. There's a lot of good information there. We do work with multiple strategies. Russell has multiple strategies in his own. I mean, he trades commodities, Forex. He also has an indices program, and this is his options program that we've covered today. Are there any more questions here while I've got a few more minutes? Doesn't look like it. All right. Well, thank you, everybody. I appreciate everybody coming on and seeing this. And again, if this is of interest, go ahead and give us a call, and we're happy to work with you. Hope everybody's having a great day, and good luck trading tomorrow. Thank you.